So hi everyone, it's Wisdom Jordan right back here, and this is lesson 10 of Forex trading. So in this lesson 10, we are going to be looking at types of Forex market orders. So we shall look at the market order, the limit entry order, stop entry order, stop loss order, take profit, trailing stop, good till cancelled, good for the day. One causes the other, one triggers the other in detail. We are going to be starting off with this type of order called the market order. So a market order is an order to buy or sell at the available market price. So for example, if the bid price for Euro USD is currently 1.2140, and this can be simply read as 2140, and the ask price is 2142. If you want to buy Euro USD at the current market, then it would be sold to you, or you would buy it at the ask price of 2142. You would click buy, and your trading platform would instantly execute a buy order at that exact price. And if you want to sell, it will also sell at that exact price. Right. So when you look at this plain chart, we want to be looking at the current, or what we call the market order. So if currently the market is at 138.000, it means that if you want to buy at this price, of course this is the exact price at which the market is going to put in your order. And then if you want to sell that price, that's the exact same price you are going to sell at. That is what we call the current, or we call it the market order. Right. So we want to look at the limit entry order. This one here, limit entry order. So a limit entry order is an order placed to buy below the current price or sell above the current price. I'll repeat it. A limit order is placed to buy below the current price or to sell above the current price. For example, if the euro dollar is currently trading at 20.50, I said we can skip this 1 point. It's not necessary. So we sound it as 20.50. You want to go short or you want to sell. Short means to sell. If the price reaches 20.70, you can either sit in front of your monitor and wait for it to hit this, at which point you would click sell market order, or you can set what we call a sell limit order at this price you want to sell at. And if the price goes up to 20.70, your trading platform will automatically execute a sell order at that best available price. That is when you use what we call a sell limit order. So to understand it more, this limit entry order, this type of order is made up of two types of orders. For example, we have what we call the buy limit order, or we have what we call a sell limit order. So when you look at the limit side of it, here we have a buy limit order. We say it is an order placed below the price, and the price then goes up. A buy limit order is set below the current price, and then the price goes up. So that's why you're seeing here on the arrow, if this is where the current price is, okay, and then here you set, okay, I'm saying that if this is where the current price is, and then you want the price to fall to this level, and then you buy, it means that you're going to set what we call a buy limit order. So the price will go below the current price here, and then it hits the price you want, and then after hitting the price you want, it then goes up. That's what we call a buy limit order. So you set it whereby the price goes down, hits the price you want, and then it goes up. So we have a sell limit order, an order placed above the current price, and the price then goes down. So for example here, if the price is currently here, and then you say that this price is going to go up, and then hits this certain price and then goes down. So it means that when it goes to the price you want, it will finally hit it and then finally fall backwards. That is what we call a sell limit order. So a limit entry order can be made up of a buy limit order and then a sell limit order. All right. So we are still on this type of market order. So when look at this plain chart again to explain, for example, and this is the British pound. This is a British pound versus the Japanese yen. That is a GBP yen on a daily chart. That is 1D. So and this is a candle chart whereby each and every candle here represents 1 day of the market performance. So when look at this plain chart, we want to look at, for example, a buy limit order. An example of how to set a buy limit order. So in a buy limit order, we said that we want the price to fall down, and after the price has fallen down, it will then finally hit that price and then reverse to go up. So for example, we can say that as soon as the price falls to this level here, it will finally come and then reverse. So for example, you see here a very nice downtrend here. So we are saying that when the price falls to this level here, the price is going to rebound. So instead of sitting on the computer to wait for the price to drop until it reaches this level, what we are going to do, we shall set what we call a buy limit order. So we shall say we have set here what we call our buy limit order. So when the price drops and drops and drops and then it hits this level, it will hit that level and then finally come to buy up, to go up. That is what we call a buy limit order. It is set below the current price and then the price hits it and then reverses to go back to up. So for example, under the buy limit order, if our current market price is here, right? And then we want the price to come and reach this level and then it will buy off later on, right? So what are we going to do? We shall come and leave the price. This is the current price. We shall wait, and then what we say, we set the system to make what we call a buy limit order. So when the price drops, it hits our desired level, it will hit it and then your buy order is triggered. After your buy order is triggered, then you can finally find out what we call a buy limit order. It is set by the current market price and then it finally goes up. Current market price drops and then finally goes up. That is what we call a buy limit order. So if it is a sell limit order, sell limit order. A sell limit order means that the price is going up, but when it reaches a certain level, it is going to sell back. So for example, when you look here, the price is nicely moving upwards, but you say when it reaches this level, it is going to finally go down. So what you do, you sell what we call a sell limit order. So when you look at this price here, it finds some little bit of support. Then you say that when the price hits this previous swing high, it will come and sell back again. What do? You come on this price you want, and then you sell up what we call a sell limit order. So you set in what we call a sell limit order. So the price will come up, and then hits this level. After hitting that level, the price will go down. That is what we call a sell limit order. So in a sell limit order, the price goes up and then finally falls down. That is a sell limit order. It is set above the current price and then it finally goes down. Right. So we are going to look at what we call a stop entry order. Sorry. So a stop entry order. So on a stop entry order is an order placed above the current price or below the current price. So for example, a GBP dollar is currently trading at 50.50 and is heading upwards. You believe the price will continue with its direction. If it hits 50.60, you can do either one of these things. Sit in front of your computer and buy at the market price when it hits 50.60, or you can set what we call a buy stop entry order at 50.60. You use your stop entry orders when you feel that the price will move in one direction. Note that you use your stop entry orders when you feel that the price will move in one direction, unlike in the previous limit entry orders. So when you look at the chart here in this image, we want to look at the buy stop. So a buy stop, we say that is order placed above the price and the price keeps going up. So if this is the current price of the market, so we set our buy price above the current price, and when the price reaches that level, it keeps going up. That's what we call the buy stop. So for a sell stop, once a play is order placed below the current price and the price keeps going down, if this is the current price and you want to sell below the price, so it means that when it reaches that level, it will keep falling down. That is what we call a sell stop order. So we have a buy stop, price is set above current market price and then it keeps going up. A sell stop, price is placed below current market price and then it keeps going down. So when you look at this chart, we want to explain what we call the buy stop for the start. So we want to start up with a buy stop order. For a buy stop order, we say that the price goes up and when it hits a certain level, it keeps going up. So for example, when you look at the chart here, the price went down, then it rose, then it went down, then it went up again. So what we do, if you look at the price here, it fall, then it rises, and then it fell. So for you might say that when the price comes back and reaches this level, it will keep going up. So what you do, is you simply set your buy order right here, and then when the price hits this level, it will keep going up. That is what we call a buy stop order. So for a buy stop order, price reaches a certain level and then it keeps going up. So for example, here the price fell down, and when it rose again, you say that when the price hits this level, this is the highest level before, it will keep going up. You simply set there your buy order, and when the price hits that level, it keeps going up. That is what we call a buy stop order. So when you look at a sell stop order, for a sell stop order, so look at a sell stop order. This is a price whereby this is a condition whereby the price falls and then it reaches a certain level and then it keeps falling down. That is when you use that type of order. So for example, when you look here, the price is falling, reaches a certain level, it bounces off back, then it falls, reaches a certain level, it goes up, then it falls, reaches a certain level, goes up, goes down, goes up, like that. So when you study the chart and look at it, you might say that when the price reaches this level, it will keep going down. So what you do is you set your sell order at that level when the price is still here. So when the price reaches this level, it hits it, and then it keeps going down. That is what we call a sell stop order. So for a buy stop order, the price is set up from the current market price, and then the price keeps going up. For a sell stop order, price is sell. So an order is placed below the current market price, and then it will keep going down. As simple as that. So we have what we call a stop loss order. Right. So a stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if price goes against you. So stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. I want you to remember this type of order. So a stop loss order remains in effect until the position is liquidated or you cancel the stop loss order. It remains in effect until the position is liquidated or cancelled, or if you cancel the stop loss order manually. So for example, if you went long on Euro USD at 2230, to limit your maximum loss, you set a stop loss at 2200. This means if you were dead wrong and Euro USD drops, instead of moving up, your platform would automatically execute a sell stop order at 220, and that's the best available market price, and close out your position for a 30 pip loss. So you now calculate pips, that is this price minus this price to get the 30 pips. Right. So when you look at this chart, if you want to explain for you what we call a stop loss order. So a stop loss order, we said, for example, it is placed to an order, or it is linked to that order in order to stop any additional losses. So for example, when you look here, the price was going up. So you believe that the price is going to continue going up if it reaches this level. So you place your order thinking the price is going to go up straight. So what you do is that when you place your order here, and then you put your stop loss right below here. So the price came. It is now your trade is executed, but the price goes down. This is your stop loss. The price will hit your stop loss, and then to stop any additional losses, which are within this range. That is when the price goes against you. Or, for example, when you look at this scenario here, the price was moving back upwards. So you think that the price is going to keep going up, but well, you are not right. The price finally went down. So what do you do? In order to cut losses, when you buy from this level and then you put your stop loss right here, it means that when the price goes against you, it will hit your stop loss and then cut off these additional losses. So a stop loss order is simply put in order to cut losses. So for example, if you look at this long candle here, it means that you can put here your buy order, and then put here your stop loss, and then you put here your other order. Okay, so here you put your buy order, you put here your stop loss order. So when the price goes above your buy, hallelujah. If the price goes down, it hits your stop loss, and then you're out, and then you cut your losses. So we want to look at what we call the trailing stop loss. This is called the trailing stop order, or the trailing stop loss. So a trailing stop loss is a type of stop loss order attached to a trade that moves as price fluctuates. Let's say that you decided to short USD JPY at 80, that is 80 or 90.80 with a trading stop of 20 points. This means that originally your stop loss was at 91. Okay, if the price goes down and hits 90.50, your trailing stop would move down to 920. Just remember though that your stop loss will stay at this price. It will not widen if the price goes against you. Going back to the example with a trading stop of 20 pips, if dollar JPY hits 90.50, then your stop loss would move to 90.70, right? However, if price suddenly moves above 90.60, your stop loss would remain at 90.70. Your trade will remain open as long as price does not move against you by 20 pips. Once price hits to your trading stop, a stop loss order will be triggered and your position will be closed. So that is the trading stop order. So in short, to explain the trading stop, so for example, you put here your buy order, and then you put here a trading stop loss of 2 pips. It means that if the price moves to this level, it goes high to this level, this stop loss will automatically be shifted to a 2 pip loss. All right, what I'm saying is if you put a buy order right there, and then you put a trailing stop, you put a trailing stop loss right here, and this stop loss is 2 pips down, it is -2, and then the price moves up like that. So if the price reaches this level, this stop loss will be shifted 2 pips below the current price, and then it goes down here. That's what we call the trailing stop loss. But if you buy from here, put your trailing stop loss here, and then the price moves backward, your trailing stop will stay there, and then you will be out of the market, right? So for a trailing stop loss, it moves with the market as long as the market is moving in your way, but it does not move away in case the market is going out of your way. So we said trailing stop buy. So for example, if you sell here and then put your trailing stop loss here, 5 pips, and then the price drops to this level, then your stop loss will also become 5 pips away from the current market price. But if the price from here moves against you, it will go backward and hit your stop loss. So we have what we call a take profit order. So a take profit order is a type of order linked to your trade for the purpose of collecting profits if the price goes in your favor. Remember this type of order. So a take profit order remains in effect until the position is liquidated or is cancelled out. So here to explain the take profit order, if you come and buy at this level, then you put your stop loss here, and then you put your take profit here, if you buy from here, if the price goes below this level, it will hit your stop loss and then you get cancelled out. But if the price goes up in your direction, it will hit your take profit, and then your account will automatically collect more money. So if the same thing, if you sell from here, then you put your take profit here, then a stop loss maybe here, and the price goes in your favor, it moves down, you will collect money. But if it goes away from your direction, you will lose a small amount of money. So in recap about stop loss and take profit, a stop loss is put to cut losses while a take profit is put to collect some profits. So we have an order called good till cancelled. So a good till cancelled, that's a GTC order, remains active in the market until you decide to cancel it. The broker will not cancel the order at any time. Therefore, it is your responsibility to remember that you have the order scheduled. Right. So we have a good for the day, that is GFD. Good for the day order remains active in the market until the end of the trading day. Because foreign exchange is a 24-hour market, this usually means at 5 p.m. East Standard Time, since that is the time US market closes. But we recommend you double check with your broker. So another type of order, we have one which is called one cancels the other. An OCO, or one cancels the other order, is a mixture of two entry and stop loss orders. So there are two orders with price. So two orders with price and duration variables are placed above and below the current market price. When one of the orders is executed, the other order is cancelled. Let's say the price of the euro dollar is at 20.40. You want to buy at 20.95 over the resistance level, maybe in anticipation of a breakout or initial selling position. If the price falls below 19.85, then understanding is that if 20.95 is reached, your buy order will be triggered, and then the 19.85 sell order will be automatically cancelled. That is what it means by one order cancels out the other. So we have one triggers another. This is the opposite of the previous one. The OTO is the opposite of the OCO, and it only puts on orders when the parent order is triggered. You set an ETO order when you want to set profit taking and stop loss levels ahead of time, even before you get in a trade. For example, dollar franc is currently trading at 2000. You believe that once it hits that 2100, it will reverse and head downwards, but only up to 1900. You set a limit order at 2000. At the same time, place a related buy limit at 1900, and just in case, a stop loss at 2100. As an OTO, both the buy limit and the stop loss orders will only be placed if your initial sell is at 2000 gets triggered. Right, hope this is clear. So in conclusion, the basic types of market orders are the limit entry order, that is the buy limit, and then the sell limit order, then the stop entry order, that is the buy stop and the sell stop, and then the stop loss and take profit and trailing stop orders. So I recap: the buy stop order, you place it above the current market price and the price keeps going up. Then a sell stop order, you place it below the current market price and the price keeps going down. Then a buy limit order, you place it below the current market price, but the price keeps going up. And then a buy limit order, you press it below the current market price, the price triggers it, the market triggers it, and then finally goes up. So for a sell limit order, you set it above the current market price. When the market goes up to that level, it hits it, and then it finally goes down. Take a screenshot of this image and then be able to memorize. So this is the end of this video about the market orders, and then we shall be looking at the next lesson where we shall go for market analysis, types of market analysis. Thank you for watching this video. My name is Wisdom Jordan. May the markets be with you. Do not forget to subscribe to this channel. Bye bye.